Ladies and gentlemen, I have the honor to have today as a guest Julian Phillips. He's one of the best analysts in gold and silver that I know. I follow him every day religiously and read his newsletters. Julian Phillips' history is in the financial world goes back to 1970. After leaving the British Army, Julian joined the London Stock Exchange, qualifying as a member. He specialized from the beginning in currencies, gold, and the dollar premium. Mr. Phillips moved to South Africa, where he was appointed macroeconomist for the Electricity Supply Commission, guiding currency decisions on the multi-billion foreign loan portfolio. He then joined Chase Manhattan, the UK merchant bank Hill Samuel, in Johannesburg, specializing in gold and silver. Mr. Phillips returned to the world of precious metals investing over 2 years ago, establishing Gold Authentic Money, and is now contributor to both the silver and the gold forecaster. Mr. Phillips has recently created a unique financial entity which protects individuals' gold from confiscation, capital controls, and penalization. Stockbridge Management Alliance and the Guardian company Ultimate Gold Trust, which adds another layer of protection. Good afternoon, Julian. Nice to see you.
And you, I'm at the other end of the world, but it gives me good perspective.
Okay, Julian, let's go now to the core of the business. How is gold and silver doing right now?
Well, I use the term they're drifting up. And I use that although the trade is a little thin at the moment. In the last year, we've seen a structural change in the market. In 2013, the emphasis was on US selling of gold, physical gold, and over the year, including the bear raid in mid-April last year, I believe the tonnage sold out of the US was 1,300 tons, which if you add that to the approximately 4,200 tons gold supply from scrap and newly mined gold, placed pressure on the gold price and eventually took it down, as we know, to 1180. However, that supply's dried up in 2014. And although the Chinese demand has not been as robust as before, we have seen the potential rise of Indian demand, which was again restrained last year in August through import restrictions, which cut back their purchases, excluding smuggling, to probably half of what they would normally take. And we're talking about 1,000 tons is what they normally take, but I believe that demand could easily be as high as 1,200 tons now.
How much do you think the black market took from that that supply, those official numbers? Do you think that it was successful?
I think that smuggling in India, it's part of the culture. There is an anti-government feeling there, which has given rise to the black market in finance. And Indians trust gold, and they have every right to do so if you think back to the beginning of the century and the price then. And unfortunately, the corruption of the Indian government and its bureaucracy has led to this disrespect of government, disrespect of law, and self-protection, which is understandable, I suppose. And so now when they put these restrictions on, we guesstimate that the smuggled amount of gold was in excess of 250 tons for the year. And it remains at that level and will remain at that level while import duties are as high as 10%. Now, this is outside the 80-20 restriction on gold imports. This simply makes it profitable for gold smugglers to bring gold in and gain that 10%, which they're doing because of the nature of the Indian gold market. So that figure is impossible to validate, but I guess that would take the net imports into India around about 750 tons, which again, as I said, the supply I expected was 1,200 tons. So we're still facing quite a considerable shortfall.
Can I turn a little bit also to China? You wrote a fantastic report about 2 weeks ago about China, that China has control of the gold price. Could you summarize a little bit what do you mean by China having the control?
Yes, we are inclined in the developed world to think that control means a vigorous dominance, deciding what the price should be, pushing it up if you felt it should go that way, pushing it down if you should feel it goes that way. And we're used to a banking system, we're used to a stock exchange where speculation, short selling, long positions is the nature of the markets. China is not like that. When they buy gold, they buy it for the long term. It's money. It's a safe haven. It's everything that money should be in terms of value. But the difference with the Chinese market is they're not profit seekers. They are buyers of gold ounces. Now, if you set that as the objective, then you find that if you set that as the objective, you will the way to buy gold is to simply go into the market when volume is available. Now, that's an important factor. It means, in essence, that when a gold price falls, for instance, and tonnages of gold come onto the market, a dealer, a bullion bank, will phone up the relevant Chinese participant and say, I have so much on offer. And then the buyer then simply takes it. This doesn't cause the price to rise or fall. It simply takes the gold off the market. And by doing this, they've succeeded, if Swiss figures are correct, in taking into Asia in the region of 2,771 tons last year. Now that is a tremendously successful way to deal in gold, I believe. It is controlling the gold market because without moving the price, they managed to take the bulk, almost the same level as newly mined gold, off the market without moving the price, which I find shows the level of control. And this tends to be misunderstood in the West because of the concept of that control. But what has happened is that vast tonnages have moved out of the developed world into the emerging world. That was their objective. They've achieved it. They have full control, and they're continuing to do it.
When can we expect China to announce how much gold reserves they have? The last time they announced it was in 2009. There was speculation that they will do it in April. Hasn't been done. There is another speculation that they might do it in September, October. What will trigger? Do you think they know exactly when they will do it, or they haven't made up their mind?
I think they will do it when a certain situation arises. It's not a time matter. They did it last time after 5 years, and it seemed to equate to the previous 5 years' local production, the extra 600 tons they pulled into the reserves. And they did that. It's clearly added credibility to the yuan, which had started its road to convertibility. And we expected it this year because China works on a 5-year plan. However, they haven't made that announcement. And I believe it is a strategic move not to make such an announcement. If they did, I look at the impact of such an announcement. It would be to probably place upward pressure on the gold price, which is not in their interest at this moment in time. They announced yesterday, I was puzzled that the Chinese premier went to London. I thought, in Chinese terms, London is not such a significant country. Yes, a financial center. And I thought it was strange. But then he announced the establishment of a clearing bank. Now, this was to clear yuan-pound transactions. In other words, to allow the avoidance of the dollar by going direct from pound to yuan, a step which is absolutely vital on the road to free convertibility. And therefore, as I've written in the past, I believe that the internationalization of the yuan takes precedent over any gold factor. And indeed, gold will be brought into that picture. I see the announcement, therefore, coming at a time when sufficient progress has been made in making the yuan convertible for such an announcement to be to the advantage of Chinese interests.
Could Russia interfere in this strategy, the Chinese strategy? Vladimir Putin seems to be he shows himself in pictures with a gold bar. The Prime Minister, the same thing. Recently at the conference in St. Petersburg, they hinted that there is some kind of a discussion about foreign exchange reserves and gold. Could the Russians, the impatience of Putin, advance or change the Chinese strategy?
I personally get the impression that Russia has a considerable amount of hormones, and therefore when it comes to these sort of matters, they make more vigorous statements. The certain Russian gentleman who's close to the Russian government this morning talked about destroying the dollar. Whereas China, it has so many dollars, it's very pragmatic, it's very inscrutable. It will move to the point where the yuan is well established in direct trading. And when it suits it, without emotion, it will make an announcement of full convertibility, and I expect the United States importers of Chinese goods have to pay not in the dollar, but in the yuan at some point, when it suits China. Whereas Russia is, should we say, a little too vigorous in its opinions and not enough common sense in terms of achieving an objective. And I do believe that Russia has a policy of increasing its gold reserves, and they've stated that they want them at 10% of foreign exchange reserves, and I believe that policy is on course. However, as to some dramatic action, I can understand how the Ukraine factor might make them make slightly wilder statements, but I believe this policy is a slow, steady, cautious build-up of gold reserves in both countries to support the arrival of the ruble and the yuan in international reserves as reserve currencies. And this is the fact, as reserve currencies, so that there's no working through the dollar to get to each other. It will be direct dealings, and that is a tremendous threat to the dollar, because the dollar is not simply the leading reserve currency. It is the sole reserve currency. If you look at their reserves, they're around about 70% in gold. This is not because they favored gold. They simply don't have foreign currencies in their reserves. They rely on the dollar to pay all their bills. So if somebody tells them, sorry, will you buy the yuan and pay our bills with yuan? They have to sell the dollar, which is in a constant trade deficit, which spells an awfully volatile and dangerous time for the credibility of the dollar.
Yeah, Julian, can I also ask you, we've heard yesterday and today some threats from Saudi Arabia and the conflict in Iraq. Saudi Arabia doesn't publish its reserves, gold reserves. They did it like China, right after the announcement of China, or close to it, in 2009. Do you think Saudi Arabia, they seem to be mad at the United States? Could they play a role in the currency wars, in the gold war?
Oh yes, they certainly can. And in fact, what's going on in the Middle East now is the greatest cause for concern to world economic stability that we've seen for many years. The danger that a sectarian war spreading across the entire Middle East is never been higher. In fact, it's there. It just hasn't been recognized as such. And one of the ingredients of such a sectarian war is that it ignores geography. So a nation like America cannot give defined military objectives because they're so tied up in this indefinable sectarian factor that can't be measured and put in place. It's an emotion that defies all logic. However, the House of Saud comes in because they are Sunni and they have a considerable number of Shiites working their oil fields. If the Shiites decided that they were unhappy and refused to work, then you're seeing a threat to Saudi Arabian oil production. The House of Saud is a Shiite dynasty that's put in place by the United States, and they're not popular amongst many of the nations surrounding them. So we have a potentially explosive situation which would threaten the House of Saud. And of course, they turn to the United States and say, you are our security, but we are your oil supply. Well, that's diminishing pretty rapidly with America with 84% of its own production. If you now, the Saudis find themselves therefore not being able to rely entirely on the United States, who are favoring some Shiite bodies, and talk is that they'll talk to Iran, which would really upset the House of Saud. So the potential for breakdown, or for pricing oil in currencies other than the dollar, or interrupting oil supplies, and we note that the 3.5 million barrels from Iraq at the moment could, if it's interrupted, lead to prices of $140 a barrel. So that would threaten the economic stability of the developed world. So this issue is a major economic and political issue at the same time. And I've never seen something that was so indefinable, unmeasurable, or difficult to quantify in the terms that we're used to. So I'm braced for anything on that front. But the House of Saud, I don't envy those people at the moment.
What do you think it's the relation? A lot of people are talking about the relation between oil and gold. Is there a link between the two? Can they move in different directions?
I would say the key link goes back to 1973, when Saudi Arabia and other oil producers, OPEC in its entirety, agreed to price oil only in the dollar. In other words, they linked the dollar to the oil price, not on its level, but in terms of the ability to pay for it. And in doing so, they added a certain quality to the dollar that it didn't have before. Previously, when it unhooked from the gold price in 1971, the future of the dollar wasn't certain. But once it was linked to oil, and everybody had to buy that oil with dollars, that gave it a reliability that it could not have had before. And that allowed it what they called its exorbitant privilege. They could print it as much as they liked, because the average small country needs 25% of its imports in oil. In other words, it has to buy dollars to that extent. So it was a small matter for the dollar to spread to other areas. Now you break that link, and Saudi Arabia accepts other currencies as well, and likewise other oil producers. The United States has lost its foothold, its firm grip upon the oil market, and it certainly can't afford to do that. So what I'm saying here is we're not talking simply about dollar dominance, but rather like a crystal vase. If you crack it, it's valueless. Now, if you break the hold of the US dollar hegemony over the world of finance, then you put the dollar on its back foot. And it is not just vulnerable. It could become extremely volatile. It could become difficult to measure. It certainly would readjust the entire currency world. Hence, gold would come back to a pivotal position in international exchanges, guaranteeing liquidity, allowing reasonable interest rates, and therefore exchangeable. And the thing about gold at that point in time is that your enemy will accept it, whereas your enemy will not accept your currency. And if you look back at the last war, one of the weapons of war was to forge each other's currency. And that's why you saw 26,000 tons of gold in the US reserves pre-war. It had come out of Europe, and it clearly, with the benefit of hindsight, now we can see it was clearly a war protection measure. Now, if you look forward to the extreme times we're in at the moment, and as they develop, we know that gold has to come in to give that credibility to currencies. If we see that, then I can assure you the gold price will be well above its record price that we've seen in the past. For one very simple reason, it's not available on the market.
Do you expect, Julian, any kind of negotiations, a kind of a Bretton Woods, a new Bretton Woods with some people are talking about a CDR backed by gold. Do you see the new system, the reset, being done at the United Nations, kind of a Bretton Woods negotiations, or would gold just impose itself through a crisis, a major crisis?
I would see gold imposing itself through a major crisis and being used in support of the current system, because it's in the national interest to have that happen. But I do not see a willing reformation, a global reformation of the currency system for two reasons. One, the world system at the moment, the IMF, has in its structure a requirement that any issue that is approved requires the votes of 85% of members. However, the US has 16.83% of those votes, which makes the IMF subject to the US. China will never accept that. They're walking an independent road. They have 1.4 billion people. They're soon to become the number one world economy. And to date, they have not said to the US, can we join? Anything. They've said, we're walking our road. We will adjust the systems to suit us. And if necessary, have a separate BRIC World Bank. So the concept of negotiation has to start from the point where the US says, right, we're not world dominant anymore. And I can't see that happening.
Can you see something like it happened in the 70s? Up to now, central banks, sovereigns have bought gold in a very discreet, organized way. Do you see the potential of a kind of a stampede for gold by central banks, a little bit like it happened when De Gaulle, the president of France, decided to exchange the dollars for gold, and you had Holland that went and Austria that went for gold, Germany, and when the Brits arrived, Nixon said, you know, the door is closed. That's enough. Do you think it could happen kind of like we have with individuals in the stock market, a run on gold, central banks desperate to exchange their dollars? Do you think that kind of situation could happen?
What I see is very close to that, very close indeed. I think that we are moving to a point where so much gold is going into the Far East and will continue to go in. It so far hasn't led to any panic rush for it, and this is due to China's surreptitious, or should we say, low-profile acquisition of gold. You've seen emerging market countries increasing their gold reserves. You've seen Russia doing so. But ostensibly in the West, there's been no move towards that. In fact, the central bank gold agreement stopped selling gold in 2009. And it's unlikely they'll sell another ounce. They will grab whatever they have left. However, in the sort of currency world that I see lying ahead, and I quote Alan Greenspan when he said that gold is money in extremis, we are moving into extreme times now, and pretty rapidly. The Middle East leading the way. This requires, as you saw in Iraq in the last 3 months, the acquisition of 90 tons of gold. And the reason given by the central bank was to add credibility to their currency. Now, let's set a pattern that I think lies ahead in the future, that the credibility of currency, when you see dollar hegemony diminish. All those currencies dependent on the dollar and related rather like the branches of a tree on a tree trunk. I see the whole tree shaking. And at that time, as we saw the swaps, the currency gold swaps through the BIS a few years back up to 635 tons. So you'll see something similar. So the need for gold will rise. But as we both know, the supply of 2,800 tons from mines and 430 tons of that, the Chinese and staying in China, and 1,900 tons scrap. If they do decide that they need to increase their holdings of gold, the volume available is so little, they'll have to turn inside their own nations. And as we saw in Korea, citizens will be required to hand their gold to the government.
You bring me to a question I wanted to ask you. You've been involved lately with Switzerland, with storing gold for protection of assets. How do you see for the individual protecting themselves with gold and silver? And do you see some discussions about Switzerland not being as secure as it used to be? How do you see Switzerland and Singapore? Some people are talking very nicely and very bullish on Singapore compared to Switzerland. How do you see, for the individual who wants to protect himself, you have a very good expertise in the field.
Yes, my involvement in protecting people against exchange controls and currency controls goes back to the dollar premium time when Britain had a commercial pound and a commercial dollar and an investment dollar called the dollar premium, and the currency traded at 30% discount on the capital side against the commercial side. I saw the same in other countries. I've seen governments try to stop people taking money out. I've seen governments try to force people to bring it back. And I look back at the 1933 gold confiscation order, and I see that governments have a tendency never to step out of their own jurisdiction, but to tackle their own people. So, for instance, if Joe Soap is holding his bullion in Switzerland or Singapore or even Timbuktu, all his government will do is to say, bring it home. If you don't, we'll lock you up and fine you. So what's the point in holding it overseas unless the structure you use protects your gold against such confiscation without you being put in prison or being fined? And that's what I've been working on. Now, you mentioned Switzerland. Well, I have to say I have a different viewpoint of Switzerland than most people who say it's weakening. And let's look at the UBS story. 45,000 US citizens had accounts in Switzerland. The names of 4,500 were handed to the US authorities because the Swiss felt that they were potential criminals, tax evasion being one of the crimes they accept now. However, 40,500 US individuals never had their names disclosed. And the Swiss made it very clear that if any Swiss banker did so, he wouldn't be able to come back to Switzerland without being locked up for breaking the Swiss secrecy laws. And unfortunately, the reality of all sides of the world, no matter how strong they are, is jurisdiction rules. And Switzerland has a 300-year history of protecting foreigners' assets. It has one of the deepest liquid gold markets in the world. It will function no matter what happens in the gold market, and therefore it remains, in my mind, the proven place to hold your gold safely. Now, if I look at Singapore, it is an entrepot, it is a money-making entity that's vulnerable to attack from the north. It has not got a history of protecting people. It does not have a liquid market. If you store your gold there and you want to sell it, it has to be transported back to a market. So I personally wouldn't touch Singapore, nor would I touch Hong Kong, which is now part of China. And I wouldn't touch Jersey or Guernsey, which is part of England. I take my hat off to the Swiss for their persistent and continuing resilience in the face of the largest of world powers.
Julian, can I ask you also, there's a lot of talk even this morning on the wires about the London gold fix and the silver fix. What is your view about it? Do we really need a fix, or couldn't be just a free market price like in any other product? Do you really need the fix? Some people are arguing in favor. Some people say that it's old. We don't really need a fix anymore. What is your view about the fix in gold and silver?
Right. Well, it's strange you should say that, because I've actually, before you came on, I was writing an article on the fix, which I'll release soon. But very good question. And you know, like all things, one has to be pragmatic and practical. What is the fix in essence? It is where all the sizable gold dealers, gold professionals, where the gold market comes together one place twice a day. It is reputed to trade 90% of the physically traded gold on any day. That excludes the contracts that are made with reference to the gold fix. And the reason it's done is because all these people get together, and their buyers and their sellers, they then negotiate a price at which all deals are done. So there's no middleman, there's no games played. Where there's a middleman, his commission is stated to the client, and the client within the bank will say, right, I'm a buyer at this price, I'll pay my commission, and the commissions are cut down to the bare minimum, and then that bank will take the net deals and pass it on to the fixers, the 5 banks, who then between themselves come up with another balanced position and issue a gold price. So it reflects liquidity and volume, and that's the key to any fix. If you took just a representative price, it might be on a deal of 10 ounces. If it's on a deal that reflects the volume traded at a particular price, it's representative. And this is a task before the World Gold Council Forum next month. And I'm glad it's the World Gold Council, because they represent the producers. The banks represent the buyers, tend to represent the buyers, or have conflict of interest because they're both buyers and sellers. And I've actually suggested in that article that it's a wonderful opportunity not to have 2 fixes in London, but to have 4 fixes, with 2 of them in Shanghai, so that you have a representative 24-hour market that does indeed reflect the sheer volumes traded at a price that reflects the bulk of that volume. And those are the definitions. It's not a price that somebody judges. It's not a price that is a snapshot at a certain moment in time. All these are corruptible. But if you can get together a system that brings together the full volume, and they all agree one price, then you've got something that you can refer to. So whether it's the fix, whether it's 5 banks, it must represent that particular feature of liquidity and volume.
We speak a lot about gold, but also silver. The restless metal, it has about 70% industrial, and the rest investment, monetary aspect. How do you see silver in this environment? Is it going to follow gold, or is it going to follow metals, commodities? It seems to have a duality. Which one do you think is going to dominate?
Well, the fundamentals, you're quite right. It's a mixed industrial metal, but it has this investment feature. And the numbers out of the Silver Institute last year showed that the investment side has become very important. And, you know, many silver investors might be very puzzled. Why does the silver price constantly follow the gold price? And my answer to that is, firstly, because it does. Secondly, because it is treated as money by many investors. And if gold is brought into the system, it will not be long before silver is also snapped up because of this feature. And so I look at silver as, well, if a silver investor wants to understand the silver price, he's got to understand gold. And I see silver as being potentially seeing a return to money once gold has been incorporated by the reserve banks into the monetary system in one way or another. But silver is money. It has been for thousands of years. And at one time in Egypt, it was more expensive than gold. But today, it is a secondary metal. It rises faster higher. It falls faster lower on the down. But it stays in tandem almost with silver. And because of this, I think that silver is a most exciting metal, a terrifying metal because of its volatility. But it is here to stay as an investment metal, and I believe in the future, a monetary metal.
I want to ask also about platinum and palladium. They are in the same family. We've seen in India when they put the restrictions on gold, some people went into silver and some people even went into platinum. The demand for platinum increased. How do you see, and with the problems in South Africa right now with the supply, how do you see also platinum and palladium?
I see, firstly, as a precious metal, I see it too easily adjusted and controlled by the producers and by the market. The emissions exhaust system that is its main user causes the price to be dominated by auto demand. On the second side, the platinum producers are in a position to control the platinum price because 80% of the world's platinum is produced here in South Africa. And we all know about the union problems. But the bottom line is this, and something that's not usually understood by the market, is that the mines need 17,000 Rand an ounce to break even. At the moment, the Rand stands at about 1070, and the platinum price at about 1440. Well, the miners have to sell their dollars to get Rands to pay their bills. So you've seen this platinum price hardly move because the demand, while it's growing, still hasn't taken up the stockpile. And the stockpile is where the price is made. But that stockpile in this last set of strikes has dropped to very low levels. So the producers now will have to, they'll take several months if the strike stops today, before they're back in proper production. The producers are now in a position to control that price. And we were expecting the Rand to drop a lot further to improve the margins of the platinum producers and the gold producers, but it hasn't happened. I expected it to be at 12 Rand to the dollar. It's still at 1070, and the platinum price is still below break-even point. So you'll see shafts closing, you'll see mechanization of the mines. The troubles are far from over on that industry, but I do believe the physical metal will perform as an industrial metal, not as a precious metal, because of these factors, and for some time to come. But I have no doubt that the producers who would like to see a price of $2,500 an ounce will eventually get there.
Well, I'll listen to you for hours, Julian. Unfortunately, time is limited. I'd like to thank you for accepting my invitation and that of GoldBroker.com for this interview. I recommend people to subscribe to your newsletters. They are just exceptional. I wait for them every week, and I read every morning. The first thing that I do is read your daily report. It's short, but so much straight to the point. No prose, no kind of long discussions, but straight in one sentence. So I advise people to subscribe to your Gold Forecaster, and look forward to talk to you again. I'm sad to finish it over here, and I thank you very, very much for accepting my invitation.
Well, it's been my pleasure, and I look forward to the next time. And I just hope that your listeners, readers, and investors don't be put off by the low gold price for the last year, but trust in its future.
Thank you very much, Julian, for myself and also for GoldBrokers.com for accepting our invitation.
That's my pleasure. I look forward to the next time.